Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal. It's the 1st of June 2023 and here are the top stories for the day. Indian economy grew by 6.1% in the final quarter of financial year 2023, nudging the overall growth rate to breach the 7% mark. But what led to the surprise buoyancy in the GDP numbers during the March quarter? And what are the key factors which made this possible? Debarya Sanya crunches the numbers. The world's fourth largest economy, Germany, has entered recession. The United States is trying hard to ward it off, and so are several large economies. But India, which has been called a shining light or bright light, continues to live up to the name. Its GDP growth registered a surprise jump in the fourth quarter of FY23 at 6.1%. On the back of a pickup in manufacturing activity, good agricultural output, and recovery in private investment. With this, the Indian economy clocked a growth rate of 7.2% in FY23. In the previous financial year, that is FY22, India had seen 9.1% GDP growth. In Q3 on FY23, the GDP growth rate was 4.5%. It was 6.2% in Q2 and 13.1% in Q1. A look at the sectoral breakdown suggests that the gross value added from agriculture, forestry, and fishing grew quicker on a yearly basis from 4.1% in Q4 of FY22 to 5.5% in the corresponding quarter of FY23. Manufacturing registered its first positive growth rate in 3 quarters at 4.5%. The gross value added by the manufacturing sector towards India's GDP grew at 6.1% in the first quarter of FY23 and then contracted for 2 quarters at 3.8% in Q2 and at 1.4% in Q3. The most substantial development was seen in gross fixed capital formation or investment. Investment breached the 35% mark for the first time in at least 2 years when it comes to its percentage share in overall GDP. But the percentage share of private consumption in the overall GDP contracted to 55% as compared to 61.6% last quarter. Government consumption, nonetheless, continued its upward trend, claiming an 11% share in GDP this quarter as compared to 8.7% in Q3.
As far as agriculture is concerned, I think it's been robust throughout the pandemic and post-pandemic. I think despite weather vagaries, I think agriculture has stood up quite well, and that is telling you about the resilience, somewhat resilience in the agriculture sector. And then government is pushing investments. That is leading to a strong performance of investment activity and also, I think, construction activity. And services which are showing strong growth are benefiting the urban economy more than they are benefiting the rural economy because most of the services are in the urban areas.
What then are the larger implications for this surprising buoyancy in Q4 GDP numbers?
Well, I think one, it is telling you that the economy has rebounded from COVID faster than what was anticipated earlier. It reduces the permanent loss to the economy, which we had anticipated earlier at around 9%. I think that is progressively coming down. And it has also, I think, it's showing the strength of the agriculture sector, which has done well all through the pandemic and even the post-pandemic, and it's now showing the rebound in services.
While challenges persist, the financial year of 2023-24 has begun with a pickup in high-frequency indicators of the Indian economy, raising hopes of a sustained growth momentum. Collections from Goods and Services Tax or GST stood at 18 trillion rupees during FY23 as compared to 15 trillion rupees in FY22, an impressive rise of 22%. Railway freight carriage too touched an all-time high of 145 million tons in March. Digital payments or Unified Payments Interface or UPI rose 43% to 14 trillion rupees in April 2023, just as the volume of UPI transactions also rose 59% to 8.9 billion. Domestic passenger vehicle sales saw a 13% jump in wholesale dispatches to 3.32 lakh units in April. Even India's Purchasing Managers Index or PMI for manufacturing in April increased to a 4-month high of 57.2 from 56.4 in March. A number above 50 indicates expansion in manufacturing and anything below 50 signals contraction. Chief Economic Advisor V. Anantha Nageswaran said on Wednesday, therefore, that risks to India's GDP growth forecast of 6.5% for 2023-24 are now more evenly balanced than a few months ago when downside risks to the forecast were greater. However, experts advise caution.
There are a couple of issues which seem to be a little troubling. One of the things, we've seen very strong growth, but we've been seeing consistently declining imports. Why are imports declining? Because the effect of the global commodity price decline, that was over. The second thing that we need to worry about a little bit, consumption is very weak. The question then is that unless consumption picks up, will we start running into serious overcapacity problems? The numbers don't really overcome this fear of the Indian economy still not being out of the woods.
I think there are two challenges in 23-24. One is the slowing global growth, which will spill over to weak demand for exports. And then from there, it will reflect in the manufacturing sector, which cater to the export demand. Challenge number two is that the central bank had raised interest rates to slow the economy to control inflation. So some impact, lagged impact will be felt. So we do believe that economy will slow to 6% in FY 23-24. And even with that, India will remain the fastest growing G20 country.
The fact of the matter is that the indicators are good. But the question then is, where is that demand side going to come from? Is it going to be more investment? Because exports are not doing very much. And unless consumption, domestic consumption picks up, it's a growth story, but it's a fragile.
The latest GDP numbers, therefore, have held true to the Reserve Bank of India's predictions in its annual report for 2022-23. The RBI has also predicted that India's growth momentum is likely to be sustained in FY24 in an atmosphere of easing inflationary pressures. But experts point out that the Indian economy is still not out of the woods and macroeconomic indicators such as consumption, trade, etc. need to be monitored carefully.
She's working her way to the corner office. Business Standard.
A positive consumer sentiment is indeed a good news for players in the FMCG sector, where margin is thin and competition stiff. And a player with deep pockets is continuously heating up the competition. Reliance Retail is now consolidating its business-to-business vertical. A few months after starting a price war in the grocery B2B space with large discounts, JioMart is now trying to improve margins. It fired over 1,000 workers in May and has plans to lay off many more soon. So what does the company plan to achieve and how will it shape its future? Bhashwar Kumar has the answer.
What do most Indian consumers want? The answer may well be affordable products which fit their monthly budget. And that is why, in the world of the Indian FMCG sector, most companies survive on thin margins. And for foreign retailers, the country has been nothing short of a graveyard. French B2B major Carrefour, Walmart, Amazon all failed to grab a foothold in the traditional Indian market. And the recent casualty was German retailer company Metro AG. Last month, it completed the sale of its India operations, including all 31 wholesale stores and the entire real estate portfolio, to Reliance Retail Ventures, a giant which has been aggressively expanding its presence. And, of late, it has been in consolidation mode. Soon after the takeover of the Metro's India business in May, Isha Ambani-led Reliance Retail retrenched between 700 to 1,000 employees from the JioMart business-to-business vertical. Reliance JioMart could lay off anywhere between 9,000 to 10,000 members of the wholesale division's 15,000 workforce in the near future. That is what a recent report in a financial daily claimed. Reliance Retail has started reviewing the roles of employees from other verticals too, and hundreds have already been put under a performance improvement plan. But apart from the immediate Metro AG trigger, what could be the reason for possibly opting for a larger round of layoffs, particularly in the B2B vertical? Well, the numbers don't tell us much. Reliance Retail, which puts out consolidated numbers, reported a 13% year-on-year rise in net profit at about 2,400 crore rupees for the March quarter of FY23. Revenue from operations at the country's largest retailer increased about 21% year-on-year in quarter 4 to about 61,500 crore. Its net profit for FY23 was about 9,180 crore rupees, up 30% from the previous year. Still, experts believe that the reason could be that JioMart is now hoping to improve margins and cut down losses in the wake of the price war it had engaged in recent years in the grocery business-to-business space.
This was waiting to happen, and we could see further consolidation in coming months as well. The company JioMart is presently focused on reducing losses and improving margins, as the company with its deep discounting measures promoted a distribution war. And with the massive expansion in chain of stores to approximately 18,000, there are discussions to rationalize some of them as per business potential. Over the longer term, the company is focused on maintaining a leaner team, covering all major areas of opportunities to capitalize on the business growth.
The B2B business is a thin margin trade and requires multiple levels of cost optimization. Reliance Retail shall leverage the Metro network for a vertical push into B2B networks for synergies between the JioMart and the distribution business. Given the importance of distribution and back-end integration for any retail business, it is an essential step for Reliance to be able to capitalize returns on the investment via enhancement in smooth supply chains, negotiation power in distribution, and providing the best products and experience to the end customer.
But Reliance Retail's presence spans retail, wholesale, offline and online. So, even though these layoffs may not be limited to the B2B segment and may occur across the retail business, why is it important for Reliance Retail to focus on and consolidate its JioMart business-to-business vertical in particular? JioMart is Reliance Retail's online commerce platform, and JioMart Partner, which sells FMCG and general merchandise in bulk to retail stores, offices and hotels, is its B2B division. It may not be the biggest or even a profitable vertical, but it is still a crucial part of Reliance Retail's plan for breaking into the group of top 10 retailers globally. One of the necessary conditions for this would be to capture a larger than before portion of the Indian middle class. And since 80% of the Indian market is still what the industry describes as traditional, after accounting for modern retail and e-commerce, Reliance set its sights on entering the segment and partnering with smaller stores by offering them competitive wholesale rates. Experts say its strategy was to move beyond a pure retail play and instead establish end-to-end control of the retail ecosystem by controlling everything from wholesale and supply chains to e-commerce and payments. So, while the recent developments have to be seen in this context, what does the road ahead for Reliance Retail look like?
The company went aggressive in opening stores, which now they appear to have slowed down upon, and also there has been a slowdown in the hiring as well. With a changing landscape of business dynamics and with digital disruptions, with each passing day, no one can lay claim to everlasting business model. However, having said that, Reliance Group companies such as Reliance Retail or JioMart are well placed to reap the benefits of India's growth story. However, the companies will have to be well prepared in case recession hits the West, because that can definitely act as a dampener to the line of business. So staying alert, expanding on need basis, and staying thrifty hold the key for these companies given the massive cost built into them.
According to global brokerage Bernstein, Reliance Retail has expanded its market share in Indian retail from 1.8% in FY18 to 3% in FY23. Clearly, there is room for growth considering Alibaba's example, which reportedly controls about 17% of the Chinese retail market. Against this backdrop, while Reliance Retail is well posed to make gains, experts caution that it must keep a lid on the cost of expansion despite its deep pockets.
Now that we have looked at what's happening at the country's largest conglomerate, let's see how the new age companies are performing. Their operational performance remained positive in the March quarter. The stocks too have shown recovery from their lows. So should investors add these to their portfolios? Harshita Singh tells us in our next report.
The shares of new age companies including Zomato, Paytm, Delivery and Policy Bazaar are, it seems, on a recovery path and have gained 10 to 34% so far in 2023. Though the scrips are still 12 to 89% below their listing prices, the recent strength is amid improving operational metrics and positive commentary from management recently seen in the March quarter. Paytm, Zomato and Policy Bazaar continued to cut down losses in the March quarter. The three narrowed losses by 48 to 96% year-on-year while maintaining firm revenue growth. Delivery widened its net loss with a dip in revenue as realizations in express parcel delivery declined. However, each of the four companies are now profitable at the operating level with positive EBITDA. Nykaa remains the only profit maker from the pack, which saw its profits dwindling in Q4. Analysts maintain optimism on these stocks but with a pinch of caution as they believe these shares are still not risk-free, given most of the firms are yet to make profits.
One thing is what we are witnessed in last 2 quarters is there is some kind of improvement in terms of their cash flows and also improvement in terms of their margins. But these companies are yet to become completely profitable at this point of time. But we need to wait and see how fast these companies going to be not profitable, and investors with high risk appetite, they can probably start accumulating these stocks at dips at this point of time. Any dip in Paytm, can be a good buy for the investors. There is no hurry to go jump and buy these stocks at this point of time. At market dips only one can start accumulating these stocks.
That said, brokerages too have remained mixed post the Q4 numbers. Goldman Sachs, JM Financial and BofA Securities, for instance, gave buy calls to Zomato with a 1-year upside of up to 57%. But Macquarie and Nomura downgraded the stock due to the slowdown in its food delivery segment. Paytm has mostly seen bullish ratings, with Goldman Sachs, Citi and Macquarie seeing an upside of up to 64%. Policy Bazaar, meanwhile, can gain 64% in 1 year as per JM Financial. IIFL research suggests selling Delivery on an unfavorable risk-reward, while Macquarie sees up to 25% gains in the stock. Lastly, Nomura has a buy call on Nykaa on hopes of steady margin expansion. Thus, investors should remain stock selective on new age firms and look to buy on declines. Today, on June 1st, investors will react to the GDP growth for Q4 and FY23, along with the update on the US debt ceiling deal.
She'll soon be quoted on the front page. Business Standard.
The key benchmark indices wilted under selling pressure on the last day of May, as traders chose to take home some gains after the 4-day rally. Moving on, a WTO panel has ruled that India's import duties on some information and technology products are inconsistent with global trade norms. India is now mulling approaching the WTO's appellate body against this ruling. But ever wondered what is WTO? Tushar Verma explains it. The World Trade Organization, or WTO, is an international organization that facilitates trade between nations by establishing rules and regulations. Its purpose is to ensure smooth and free trade among member nations. To that end, its member countries negotiate and sign agreements which are ratified in their parliament. With 164 member countries, the WTO represents 98% of all world trade, and its role is critical in world trade. The WTO was established in 1995, but its origins trace back to the post-Second World War era. The United Nations was formed in 1945, but it did not have a trade agency. So, 23 countries met in Geneva and signed a General Agreement on Trade and Tariffs, or GATT, to liberalize trade and reduce discrimination. It was expected that GATT will be superseded by a UN trade agency. A UN trade agency did not materialize for a long time, but GATT continued to grow. By 1995, it had 125 signed members. That year, the Uruguay round of negotiation adopted a treaty that resulted in reduced tariffs on industrial goods by 40%, reduced agriculture subsidies, and included new agreements on trade in services. At the same time, the Uruguay round adopted a new international organization for monitoring trade that came to be known as the World Trade Organization. Today, the WTO defines its objective as to help its members use trade as a means to raise living standards, create jobs, and improve people's lives. It also provides a forum for its members to negotiate trade agreements and to resolve the trade problems they face with each other. An example of the WTO's role in facilitating trade negotiations is the recent judgment against India in the Information and Communications Technology or ICT import tariff case. The European Union had alleged that India's import tariffs breached its obligations under WTO rules to impose zero duty rates on ICT goods. As the impact of various trade agreements continues to evolve, the WTO remains an essential institution for facilitating global trade and economic growth.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The WTO's appellate tribunal is non-functional for nearly 2 years due to the US's blockage on appointment of judges. And with India's appeal, the case of import duty on IT products is likely to prolong. Hope this episode answered all your questions about WTO and its functioning. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching. See you tomorrow.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.